What's up everyone, it's Karthik with MoneyVest, and markets taking a little bit of a pause ahead of the CPI numbers. So tomorrow indeed is going to be a very important day because we do have the inflation numbers coming out bright and early at 8:30 a.m. Eastern. The Treasury yields, the 10-year Treasuries, the longer-term bonds also did spiking a little bit here on the day. We talked about how eventually that is going to be a little bit of a problem for the markets, and today we did see a bit of a pause in this entire rally that we have been witnessing over the last 4 to 5 trading days. As I mentioned in my yesterday's market update, the markets have added over $2.6 trillion worth of market cap in the last 5 trading days alone. So we're seeing a little bit of a pullback or just this cooling off period in the market as the Dow Jones was down almost 1%. We had the S&P 500 down about 29 basis points, and the Nasdaq was more or less flat here because almost every single stock in the Magnificent Seven, in fact, pretty much every stock in the Max 7 was higher instead of Tesla. Tesla, of course, being the only loser on the day here, down over 6% for the right reasons, as we discussed, because Tesla, of course, has been on this parabolic run. It's gone absolutely ballistic, had a beautiful close of over $350 on the dot yesterday. So it only makes sense why there is going to be some profit taking, down over 6%. Shedding over $74 billion on the day here, with of course Meta, Google, Amazon, Microsoft, Netflix, Nvidia, all these other stocks pushing higher, and Apple was basically flat. Now, that being said, I did a little bit something crazy because just because Tesla is coming down doesn't mean that we can just sit back and do nothing and just let that profits turn into losses. We can actually hedge our positions as well, and that's exactly what I did because I was anticipating some type of a pullback or a correction here from Tesla after the parabolic run-up that we have seen. So what did I do? Well, I went way out. I went into December 2026. We're talking a couple years out, way out of the money calls that I sold on Tesla, and I pretty much sold them for $47.90 a piece. So that's the premium that I received per contract. So multiplied by 100. So we're talking just under $5,000 per contract received in credit. That's a premium. So all in all, just under $10,000 because I really only sold 2 calls. I could have sold 3 or more than that, but I really don't want to risk too many shares for just that insane strike and of course that insane expiration that we've got. But just collected under $10,000 for the calls that I sold. And guess what? Tesla stock, the fact that it sold off 6% today, this $9,578 that I received is now, these calls are now worth $8,000. So in other words, I would have to pay $8,000 to buy these calls back. So that difference is the profit. So I received $9,578, and if I give back over $8,000 to buy these calls back, if you do the math, the difference is just under $1,600. And that was just for today. If Tesla continues to sell off, I will receive more and more of that premium for selling these calls. So that's a great hedge for me, like considering how parabolic this run up has been. So if Tesla stock comes down, I'm going to be able to lock in a lot of this profit. If Tesla stock keeps running up, that's totally fine. I am capped up to as much as $748. So if Tesla doesn't go up to 748 in the next 2 years, then I am pretty solid. I'm pretty good. Of course, if it gets beyond that level, that's when I'm going to start throwing my hands in the air. But until then, we are sitting pretty. So again, if you want to get access to all these trade alerts and find out exactly what we're doing every single day, weekly trade alerts, weekly updates on the options portfolio, link's going to be down below. There is a 16% annual discount that's also available that gives you access to the entire MoneyVest website, the platform, as well as all the trade alerts, the Discord channels. You can engage with our entire community of thousands of investors and traders from around the world. And of course, get access to all the members only videos, as well as all the options portfolio updates and the trade alerts as well. So link's going to be down below. We'd love to have you on board. If you have any questions, I am always one message away. So if you reach out to me, I will get back to you right away. So Tesla price target also raised to $400 from Wedbush. And we know that Dan Ives has been covering Tesla for a really long time. He says that Tesla is the most undervalued AI name in the world. And of course, the presidency of Donald Trump is going to be a huge win for Tesla. We've discussed all of these things in our previous updates. This is going to be a game changer for the company. And he also suggested that Musk's strategic role as an advisor to Trump could greatly benefit Tesla in regulations as well. He's gonna have a significant seat at the table, and Trump's win changes the whole game for Musk, for Tesla, for autonomous vehicles, for FSD, and they'll still have issues on states. This is not going to be a 100% smooth road, but this is a much different stock than it was a week ago with Trump in the White House now starting January of 25. So again, there's a lot of hype. There is a lot of focus around Tesla. And in my opinion, it's one of the best stocks to trade right now, considering how much volatility we're seeing. What the premiums are jumping back and forth between calls and the put side. So, we were expecting a little bit of that retracement, right? So, if I quickly go over Tesla's technical analysis, what you'll notice that we were already expecting some type of a pullback on Tesla, right? This rally was obviously not going to be sustainable to a point where we see green days every single day, but this was expected, right? We were going to see a little bit of a pullback considering how overbought the stock really was. So this right here inside this green rectangle is where I've got that support area. 270s up to as much as 315. Those are the two levels that I'm watching very closely. And of course a resistance all the way up to as much as 370 to pretty much the all-time high, which I do believe that Tesla is going to eventually take out. It may not be, this week, next month, or next year, but eventually I do believe that Tesla is going to take out its previous all-time high from well over $414 per share. But a little bit of a short-term pullback, of course, is okay. And that's exactly what I'm hedging for. So right now, already up $1,600. If Tesla sells off even more, we'll be closing it out at 50 to 60% profit. That's going to be nice $4,000 or $5,000 profit for just this simple hedge. And we'll continue to run the game here with wheeling Tesla stock. Now, coming over to, again, that was the trade. You can pretty much access all the alerts with the Discord and again, the Patreon link down below. But over $143 billion worth of outflows for S&P 500. And big three, we had $118 billion inflow thanks to NVIDIA and Microsoft. Apple was pretty flat. And then Magnificent 7 here, $87 billion. Top 10, $75 billion. Of course, Tesla losing majority of that market share, down over $74 billion after gaining over $100 billion yesterday. And then we had Amgen, Eli Lilly, we had Broadcom, companies like United Health, Advanced Micro Devices even was down over 2.5%. Johnson & Johnson and Home Depot, they were all selling off, with NVIDIA gaining the most on the day here among S&P 500 companies, $77 billion. So it's kind of like a clear rotation out of Tesla over to NVIDIA. So my portfolio on the option side didn't really move much because I have pretty much NVIDIA and Tesla in that portfolio. So whatever I lost on Tesla was gained on the NVIDIA position. And Microsoft, of course, was up $42 billion. We had Amazon up $23 billion, Google, Adobe, Walmart, Netflix, all seeing some decent inflows of $5, $6, $7 billion respectively. Now, coming over to the most important catalyst for tomorrow. So tomorrow, 8:30 a.m. Eastern, is inflation. CPI numbers is something that we wait for every single month. And these right here are going to be the expectations from CPI month over month. 0.2% expected. So that right there is going to be that number. And then inflation year over year, we're talking headline at 2.6. Now this right here is expected to increase on a year over year basis from 2.4 to 2.6. If you come over to this right here, this is the headline CPI. You can see that it's sitting at 2.4. It's been trending lower. So this is part of the disinflation that we're seeing right now from CPI. But really what we want to see is this number come down to like closer to 2%, below 2%. That's the Fed's target. And of course, a little bit of an acceleration back up to 2.6. At least that's what the markets are pricing in or expecting from tomorrow, right? That's going to be the expectations here. 2.6% is not going to be, in my opinion, very well received because that is suggesting for inflation stabilizing a little bit and re-accelerating back up. Now, a bigger problem is not going to be headline. It's going to be core when you strip out for food and energy. So that's going to be these numbers right here. Estimated 3.3% on a year-over-year basis. So that's going to be stable on a year-over-year basis, and month-over-month, core is expected to increase 0.3%. So if you come back over to these charts, it's really this right here, which is all items less food and energy. That's going to be the real concern from the market. And if you see 3.3%, that's on par with expectations. I expect a little bit of a non-reaction from the market. But if we start to accelerate back up, let's say 3.4 or higher, you better believe it and have your cash ready because there's going to be some buying opportunities if inflation comes in hotter than what the expectations are. And of course, if you come in better, lower, 3.2, 3.1, 3 or lower, then of course that's going to be another some more momentum to the market to the upside, we could resume this rally to the upside. So this really is going to be the big question tomorrow, is where we end up with core CPI. A very, very important data point for the market, as we already know, because this is really what's going to dictate the Federal Reserve's policy, quantitative easing, whether we're going to see more rate cuts or not. This right here is the number that's going to dictate everything, right? Whether we get a higher than expected number, below 3.3, 3.2, because eventually this is what needs to come down to 2% for the Federal Reserve to be a lot more confident that inflation is indeed easing. Now, PPI numbers are scheduled for Thursday, and Jerome Powell is also talking. So this right here is when he's also giving us a speech on November 14th at 3 p.m. Eastern, right about during market close 1 hour before. And we got retail sales numbers coming out later this week on Friday, November 15th, estimated 0.3% month over month increase. Now, coming over to the market, we are still pretty solid. I mean, most of the indices and of course the market sectors are sitting well within 2 to 3% of their all-time highs. In many cases, well within 1% of all-time highs. Russell 2000s back near all-time highs. S&P 500, Dow Jones, the comm staples, communication services, discretionary, everything is trading well within 2 to 3%, like I said, of all-time highs. And if you take a look at some magnificent stocks here, Apple is in a pullback, down over 5% from all-time highs. Amazon, Meta Platforms, Nvidia, they're all well within 5% of all-time highs, so in a dip. Microsoft's in a pullback along with Apple. Google is in a pullback along with Apple and Microsoft. Broadcom also in a pullback, and Tesla. I mean, that recovery has been phenomenal because, up until today's sell-off, Tesla was within 20% of their all-time high, so it was in a correction, but not in a bear market. But because we closed down over 6%, we're back in a bear market. We're still down 20% from our all-time highs of $414, which, like I said, eventually I do expect Tesla to take that out as well. So that's where we are. And now let's shift gears to the 10-year treasuries. Now, this is really what's causing a little bit of problem to the entire market. And as I mentioned before, this is more of a fiscal debate. This is more of a budget deficit and debt, national debt debate, because eventually what's going to happen is if we don't see a very sustainable path to the level of deficits and the national debt, we're going to be expecting somewhat of a higher interest rate environment. So I was talking about this in our Discord. I mentioned that the probability for us to see lower interest rates is really low because, as we know, that Trump is going to be focused very much on growing the economy as much as possible, right? He is going to be pro-business. He's going to be pro-capitalism. He's going to be pro-markets and pro-economy. What he really wants, and he's going to hammer on this point with Jerome Powell pretty much all the time. And, during his presidency, I think there was over 100 times that he tweeted at Jerome Powell to lower interest rates. Like, he was pretty adamant to cut interest rates, and he was constantly bugging Jay Powell to lower interest rates. Of course, FOMC is going to operate in a very independent way. They're not going to take into account, what the president is saying or what anybody is saying, because they're supposed to operate independently, right? That being said, as we know that Trump is going to be very much focused on growing the economy. Now, the more you invest in the economy is the more you grow, right? If you invest aggressively, the more you grow. And where are you going to get the money from? And of course, the tax revenues are not going to be enough. They've never been enough, right? That's why the US runs a deficit every year. And so if they're never going to be enough and the deficits keep increasing, like they keep going up, then obviously what's going to happen is there's going to be an oversupply of treasuries. There's going to be an oversupply of bonds. And if there is an oversupply, prices come down, yields continue to go up. And that's been actually one of the reasons why, if you take a look at this right here, this is the odds of Trump winning along with the 10-year treasuries. So as the odds of Trump winning went down, so did the 10-year treasuries. But they kind of bottomed out around August and September. And as the odds of Trump winning increased again, so did the 10-year treasuries. So it's kind of crazy because if you come over to this chart, you'll notice that August, September was kind of like the bottom for the 10-year treasuries here at 3.5%. And this entire rally that we've seen from 3.5 to 4.5, so that's a full 100 basis points or 1 percentage point, has been on the back of Trump's odds of winning the election going back up. And why is that? Why is that the case? Well, if you come over to the U.S. federal budget, Congressional Budget Office, and the estimations that they've put together, under Donald Trump, they're expecting a $7.75 trillion increase, for the deficits here between 2026 and 35. Like that's how much it's going to increase on the mid guidance side, right? So from 2025, when he's going to be in the office all the way to the next 4 years, but that how much is expected to increase in terms of those deficit spending. That's how much of an impact it's going to have. So fiscal impact of the Harris and Trump campaign plans. This is in trillions of dollars from 2026 to 2035. Now, if you essentially go over to this, which of course is going to be a part of the tariffs, right? If you look at what President Donald Trump has shared about his economic plans over the last several months, one word comes up again, and that is tariffs, right? President Trump has said that he plans to install a blanket tariff of 10 to as much as 20% of all imports, with additional tariffs of 60 to 100% on all goods brought in from China. So while this is all going to be very, very good for the economy, right? Tax cuts, lower corporate tax rates, maybe even lower personal income tax rates, and again, more spending to kind of improve the quality of the standard of living for American citizens, and of course, spending more on defense, more on infrastructure, healthcare, education. Everything is going to be booming. Everything is going to be great. Economy is good. Markets are good. Everybody's happy. But what's going to be the end result? There's always a give and take. There's always a balance of risk. And the balance of risk in this situation is higher interest rates. I'm not really sure how they're going to control the interest rates if there's an oversupply of treasuries, if there's an oversupply of bonds, because they've got to pay for this stuff somehow. So that money has to come from somewhere, right? If the government is going to be doing a lot of deficit spending, then of course there's going to be an oversupply of bonds, which leads to lower prices, which leads to higher yields because of that inverse correlation between prices and the yields. Now that being said, the markets, of course, are still pricing in for a 62% probability that we're going to see another 25 basis points worth of cuts from the Federal Reserve in the December meeting. That's going to be after tomorrow's inflation numbers and one more inflation print and unemployment numbers that come out in December, and 37.9, almost 38% probability that they're going to keep rates steady as where they are. Now, the national debt and the deficit issue is one of my biggest concerns, but that is more of a longer term concern that I think 10 to 20 years out. Other than that, I think in the short term to medium term, I still do believe, and I mentioned this before, that this is all of this, like the entire political landscape and moving forward the next 4 years is going to be pretty good for the economy and the markets. But the end result, right, there's always going to be this balance of risk. What's going to be the end result of all of this? What's going to be the consequences of such a significant or excessive deficit spending? Significant amount of import tariffs and taxes and duties that are put on all the goods and services imported into the United States, because that is eventually going to or could be inflationary in nature, right? Because people are paying a higher price to import things. Of course, Trump wants to push for local, manufacturing, local production, make in America. That's kind of like the whole idea behind this of putting a lot of tariffs on imports. But how is that going to play into the whole inflationary landscape, as well as the Federal Reserve and what their role is going to be with interest rates? Because if inflation doesn't come down to 2% or lower, the Federal Reserve is really going to be in a very tough spot to kind of fight between their dual mandate. Because the last thing they really want is to be in a situation where both inflation and unemployment is higher at the same time, because then they won't have a decision they won't have a choice. They'll have to raise interest rates to control inflation. Economy comes secondary to inflation, and I'm sure that's going to piss Trump off quite a bit. So that's going to be something to keep in mind as yields continue to move higher, which in my opinion, there is a very high likelihood that we are in a higher interest rate environment in general, just because of everything that I mentioned with the deficit spending, oversupply of bonds, significant amount of issuance. We are in a higher interest rate environment unless Federal Reserve decides to start buying bonds again. They were one of the biggest bond buyers during the COVID time, and they were buying billions of dollars worth of treasuries and mortgage-backed securities to create that demand to push yields lower. If they start buying bonds, then in only then scenario that I expect yields to come back down and stay down. The idea is not for the yields to go up or go down. It's for them to stay up or stay down that actually ends up making a bigger problem for the entire economy and the markets. So the longer the yields are higher, the more problematic it's going to be for the equity market eventually. So that is something to keep in mind, of course. And the Money West Index sits at just over 3.85, so we're nowhere near close to greed or euphoria. This is a warm market, but this is certainly not a hot market. Technically speaking, we are, of course, near overbought levels here after tagging up to that 6,000 point level. Support level is going to stay roughly at 58.77 down to 57.66. Of course, for the S&P and NASDAQ here also pretty much trading near overbought levels here with the RSI just over 68. Slightly down today. Support level is going to stay put down at 18.6 for the NASDAQ. Bitcoin hitting a new all-time high at almost $90,000. So that's an incredible milestone for Bitcoin. So congratulations to everyone. Volatility coming down a little bit over 1.7, almost 2%, back under 15. And crude oil prices also trading back under $68 per barrel. And the MoneyVest index, again, we're nowhere near close to greed or euphoria. So this may seem like a euphoric or greedy market, but this is, again, very, very stock specific. More broadly speaking, we're nowhere near close to greed or euphoria in terms of sentiment yet. Fundamentally, technically, sure, we're overbought and expensive, but momentum-wise, sentiment-wise, we're not there to those levels of greed or euphoria just yet. Now, coming over to individual stocks and starting with Apple here. And Apple, again, continues to consolidate sideways. Support level is going to stay put at 221, resistance all the way up to $236. Amazon here, on the other hand, also consolidating sideways, slightly up after hours. Support level is going to stay put at $200, and we're seeing a little bit of that resistance roughly at $211 for Amazon. Tesla, we already talked about this earlier in the video, but I'm going to do a more stock specific video on Tesla once again. Resistance stays put at $370 to as much as $400 per share. We got a nice little range of that support in the 270s to as much as $315 for Tesla. Coming over to PayPal stock, and PayPal here continues to flirt at this 52-week highs of $87, $88, $89 per share. Support level is going to stay put at $81 for PayPal. Visa here also trading pretty much near all-time highs with a little bit of a gap to fill to the downside. Support level is going to stay put at $291 for Visa as well. Talking about Nvidia, and Nvidia here pushing back up near all-time highs, just trading under 150. Support level is going to stay put at 144, down to as low as 136. And of course, we got a big resistance here for Nvidia, sitting roughly at 149, closer to 150. That's pretty much the all-time high for this stock. Talking about advanced micro devices, coming back down to that support here inside this green rectangle over here. Resistance all the way up to as much as 172. As we know, that's been a level where AMD has been getting tagged at quite a few times, and of course getting rejected right away. So that's going to be that level of resistance, support inside this green rectangle right now. Coming over to Meta Platforms, which is going to be right over here. And Meta here had a pretty decent day, I think, after slashing 40% of their cost in EU. Meta obviously did a little bit better, 20 basis points higher, but nonetheless very flat. Resistance is going to stay put roughly at $602. Support level staying put at $579, of course, inside this area of demand as well, sitting roughly between 540 and 580. Coming over to Google, and Google here pushing up to that resistance at 183, 184, performed one of the best here on the day, pushing up over 74 basis points, and support level is going to stay put at 175. If you do get eventually a breakout above this level, next target is going to be 192 for Google. Microsoft, on the other hand, also pushing up over 1.2%. A lot of consolidation sideways, so really hasn't seen a lot of momentum, not a directional move from Microsoft yet. Really what we're seeing is a lot of consolidation in this range, sitting between this area of demand in the low 400s up to as much as this resistance in the 430s and 440s. Coming over to Netflix, which indeed hit a new all-time high, very overbought right now. So I'd be very careful if you've got a Netflix stock, if you've got a lot of shares, I would be looking at selling way out of the money, long dated calls here. You can collect a lot of premium. That's one of the beauties of selling calls is you can go as far as you want, you can go as up as you want and collect a significant chunk in premium. And for the next pullback, you can cash in. That's exactly what I'm doing with Tesla right now, as it has become very overbought after this parabolic run. So Netflix also very overbought. Be very careful on this stock. And then finally, we come over to Enphase and Costco. Enphase unfortunately continues to bleed here. Support level, as we discussed, $58, $59. So that right there is going to be that level to keep in mind. Very oversold on the RSI, the MACD, 3 to 4 consistent days of red here for Enphase. There doesn't seem to be any support in sight, but $58, $59 is going to be that next level to keep in mind for Enphase. And finally, coming over to Costco, coming down a little bit. Support level is going to stay put at $919, $920, down to as low as $867 for Costco as well. So a lot of consolidation in the market overall. What I'm doing personally is, again, taking advantage of this market momentum to sell calls, getting ready with more cash so I can start doing some buying once again if the market presents that opportunity for us. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and don't forget to subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you're interested in joining us. 16% annual discount here gives you access to 2 free months, so you won't have to worry about it. And of course, a couple more spots left. This gives you access to the entire MoneyVest website, options trading portfolio, weekly trade alerts. Everything's going to be included with the link down below. As always, happy investing. I'll see you all in the next video.